And so when these stocks are selling off, they definitely become hard to buy. But if we detach ourselves from the actual price action and the ticker symbol, Warren Buffett is sitting on his largest sum of money ever, over $180 billion. Now, in this video, I really want you to pay attention to what Warren Buffett states in his annual meeting.
Sitting on $168 billion of cash, which he told us today is now more than $182 billion. His questions are, one, what is Buffett waiting for? And two, why not at least deploy some of it?
Pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it, and we don't use it now at 5.4%, but we wouldn't use it if it was at 1%. Don't tell the Federal Reserve that, but we prefer it. We only swing at pitches we like, and if anybody tried to swing at every pitch or felt that because they hadn't swung at a pitch for the last two pitches, they ought to swing at the third one or something like that.
This is not a guy that's going to come out and say he's bearish and he's concerned about the economy. But the fact is, actions always speak louder than words. So there's a few things we're going to talk through in this video on what I like about what Buffett said and what we need to be cautious about. The first thing I really want to point out is where valuations stand currently. We're trading at 26 times earnings on the overall index on the S&P 500. And Buffett's sitting on record cash here. He's only going to swing at pitches he likes. And I really think we need to take an approach like this, especially in the type of market where we're in. But the first thing we have to start thinking about is the correlation between real yields and stock market performance. So Buffett was stating that he's basically getting 5.4% on billions and billions of dollars, which in itself is just going to grow his earnings without taking on any risk, because he believes that there's going to be pitches he's going to swing at probably sooner than later. As we know, Buffett, he is a very patient investor. He waits for the right time. He doesn't have to time it perfect, but it has to be a deal. And so he's really good at discounting the emotion out of the market, really understanding true valuation and being patient enough to strike when the biggest opportunities present themselves. And I really think that's something we talk about on this channel. A lot of people make fun of the fact that, I have 40% of my portfolio rolling in 3-month treasuries, and the majority of my net worth is actually rolling in 3-month treasuries, because it's a 5.4% pretty much risk-free. And when we think about a market that's returning historically 8 to 10%, we're nearly halfway there without any risk. And that's where we talk about equity risk premium. At what point does it make sense to jump in the stock market? There was a few things I pulled from this annual meeting. And the one thing is that how humble Warren Buffett is. He states that he could be missing AI opportunities that he doesn't understand. And he also admits when he lost money on something like Paramount Pictures. So even he is still learning, as he stated in his annual meeting. And that's just really, really humbling and lets you understand as an investor, if you have a process, you're going to make mistakes even when you think you have everything right and something looks like it's on sale. There's some things out of our control that we didn't see coming. And so when I look at this market, I find it harder and harder to really sift through the opportunities where we want to swing at some pitches. And what that really means is that it's such a great opportunity that you're willing to put 40, 50% of your net worth in there. And it's a company that you're willing to invest in and know that they're going to be there in 20 and 30 years. And when I look at the overall valuation of the stock market and I look at opportunities, I'm not extremely confident that there's that many opportunities out on the market where if I bought it today, in the next 10 years, it's going to be up and I'm going to sleep well. To me, a lot of these valuations are extremely stretched when we talk about companies trading at over 25 and 30 times earnings that have revenues and earnings growth actually slowing and decelerating rather than expanding. So there were a couple names that I was looking at that I was interested in, but along the way, there have been a few opportunities that I did swing at, and I think most of you guys that have been subscribed to the channel know the opportunities that I'm talking about. The sell-off to me on CVS is definitely one of those opportunities where I thought anything under $56 on a company like this is a tremendous buying opportunity. Now, this company is dealing with a lot of different things, but that's what allowed it to be at the price that it's at today. There's not many companies that are doing over $300 billion of revenue and paying a 4.75% dividend that have a pretty defensive sector. Now, they are dealing with a lot of healthcare costs going up, but I believe the way their business model is set up, they're going to be able to control more costs than the average healthcare providers. Because of all the acquisitions that this company has made, and then they're in some sort of transition at this point in time, it's definitely going to be some growing pains here. But if I think 10 years from today, I think I swung at a really good pitch here. In buying Pfizer around $25 a share with over a 6% dividend yield seemed like another pitch that I had to swing at. This is a very cyclical business, so it does have the ebbs and flows. But this was also one of the most important companies when the world was at most uncertain times. These tend to be some of the best opportunities that we've seen. And one example that really sticks out to me is when Meta dropped from $375 a share down to $95 a share. And this was one of those pitches that I really should have swung hard at, and I didn't, because when things are happening, it's really hard to keep a cool mind and detach yourself from all the noise that's outside. People downgrading the stock. They're never going to get their business model right. There's now more competition. And the more that people start talking crap about this company, but yet the company still has very strong fundamentals, the more we should really be buying, especially if they have a competitive advantage and a moat. And so when I look at Pfizer and CVS, I'm not saying it's going to give me the returns that Meta did, but I do think that this was a generational buying opportunity for healthcare. And those were the two individual stocks that I thought were really on sale. Now, of course, I could be wrong here, much like Buffett was wrong on Paramount Pictures. But when we look at the market as a whole, and if you're an individual stock picker, I really think it's important to actually have patience here. Sometimes we feel like we have to buy something, we have to do something with money. But right now, as I stated, when you don't know what to do, what is so wrong with taking 5 to 5.5% risk-free and waiting for that pitch to come your way to where you look at it and it's a no-brainer. It's an absolute no-brainer. It's a tremendous buying opportunity to where you would be willing to sell everything you possibly had to buy that individual stock. And are those opportunities in the market? And I really don't think they are. I really think people are stretching because we are at the end of a business cycle. And at the end of a business cycle, the best way to handle things is not jumping into the euphoria, being patient, picking your opportunities, build cash, because when we come to the end of a business cycle, there is usually a tremendous amount of opportunities that you never thought you were going to see coming. And that's why I believe Buffett's sitting on $180 billion of cash, because those opportunities that he has to buy, he has to put a tremendous amount of capital to work, but it has to make sense from a risk versus reward standpoint. When you have $180 billion in cash, earning 5.5%, why take on the risk unless if it's a pitch you need to swing at? As always, guys, really appreciate your time. Thanks for spending it with me, and we will see you in the next one.